Hi everybody, welcome to the Baguette Investor channel for a new video. Today I want to talk about something very interesting, a little bit technical, but I hope you'll think it's very interesting too. We're going to talk about risk management. So risk management is a very complicated and often not thought about by most traders. For example, on Twitter, most people do a lot of technical analysis, post a lot of charts, but I've never seen anyone post their risk management. Maybe because it's not sexy, maybe because it's not that easy to understand. So I'm going to make today a video to explain the risk management for Choppy Markets. This is going to be an introduction to risk management. I already did some videos like 1 or 2 months ago, but I think it's a topic that I really want to dig into the channel. I know it's the videos about risk management don't work as well as the videos on technical analysis because, as I said, it's much sexier to talk about technical analysis, but we're going to dig into this, and it's not sexy, but it's something you absolutely need to master if you want to survive in the financial markets. Otherwise, you're just going to blow up. So to be very clear, I'm going to give you a very quick example of what I mean by risk management. When you take a position, let's take the position with, we're going to go more on the short side. Let's say you take a position, you take a short. So the white line here is your entry level, and the red area, the top of the red area there is the stop price. So when the price goes there, you'll be stopped and you'll be taken out and you take a loss. The risk management is how many positions you open and how many risk you take per position. You can see here risk is 0.2%. So you tell the computer how much money you have in your account, so 30,000 for me, and you tell the computer how much risk you're willing to take, so 0.2%. If the price reaches the stop loss and takes me out of the trade, my loss will be equal to 0.2% of my trading account as a whole. So it's 30%. As you can see, if my trade becomes a loss, my account valuation will be 29940, and if this trade makes it to the take profit, it will be 3112. I hope we're clear. Bitcoin is starting to dump. At the end of this video, I might going to need to trade a little bit, but we're not there for it. So what's been going on for most swing traders for the last weeks is a really very bad market. Markets are not always the same, as you know what. I took some notes right there in front of your eyes so you can follow me. Markets are not always the same. There are 3 kinds of markets: bullish, ranging, and bearish. When the markets are bullish and bearish, it's good for me, and I hope it's good for you. But I really am really bad at trading range markets. The problem with range markets is the success rate of your trade. The success rate of your trade is very simple. You take 100 trades, how many end up becoming wins and how many become losses? A success rate of 80% means that on 100 trades, 80 of your trades are going to be making money. Simple. I hope you understand this very simple metric. The success rate is maximal during pure bullish markets and is minimal during range markets. To be clear, in a strong bullish or bearish market, if you're a good trader, you can get 80% success rate. So 80 out of 20 trades is making money. And during choppy markets, you're going to have a 10% success rate. So 1 out of 10 trades is just making money. All the others are just losing money. And that leads to the point, if you use the same risk management when you're trading directional or when you're trading in range markets, you're going to blow up. Because when you risk a lot of money, but you're making 80% of your trades successful, you're going to make a lot of money because, well, you're going to only lose 20% of your trades if you have the same risk reward. Of course, we're not going to go into more complicated stuff. Don't if you know things about that, don't make it more complicated in the comments. Just stay to the point. You're right, it's more complicated than that, but we're not there yet. And in choppy markets, 1 out of 10 trades is only going to make it. So 9 out of 10 trades are going to lose. So to make an example, we're going to see you have I have this graph, which is MTV USDT, but the asset is not important. It's the price action that matters for technical analysis. You see, you have a first phase of a directional market. So in this market, all the trades you're going to take are going to have a very good success rate. You're going to have like 80%. You take all the breakout around there, and you're like 80% successful. And then you start to take the breakouts there, and you're going to not do anything. You're going to be, your stop loss is going to be hit very often. So there are two cases. One, you use the same risk management for all markets. So you do 1, 2, 3, 4, and 10 trades, and we'll see what's the performance at the end. So the guy does a trade, loses 1% of its capital, ends up having $900 US dollars. Then he does another trade, loses again 1%. Then another trade, loses again 1%. Then another trade, loses again 1%. And it goes all the way to 10 trades. You end up losing 10% after 10 trades. After 10 losing trades, you have lost 10% of your account, which makes sense because 10 trades with a 1%, 10 times 1% is minus 10%. Makes sense to you, right? And then first, when you're in this period right there, I'm going to try to make a drawing. No, that's not text. Sorry, it's drawing. I'm going to make a drawing. You are at this period right there, this right there. I'm showing you with this very unuseful thing right there. The market is shifting from bullish to range market. So of course you can't change your risk management right away because, well, if you start to change your risk management every time there is a red candle, you're not going to do anything. You need to start changing your risk management when the market starts to range. For example, you see around this period, the market starts becoming a range market. So what you need to do is to decrease your risk per trade. So you first make a trade with 1%, for example here, and the trade does not work. You lose 1%. Then you decrease your risk to 0.5 because the market goes more and more into range market. You lose 0.5%. And then all the trades you're going to make during this range market, and it goes the same for the chart we have here. Both of these charts are textbook range markets, especially this one, which is the Russell 2000, the small caps index since 2021. The whole year has been basically a range market. If you start after these trades risking only 0.25%, you end up losing only 2.47. And that's a very big difference. If you use the same risk management for all markets, you lose 10% of your money after 10 trades. If you adapt your risk management to the market cycle, you lose only 2.47%. So we're going to give this to 2.5%. I'm going to give it one only. There you go, 2.5%. That's a very big difference. And this is one of the things that makes successful traders successful. It's not because they know better everything than you. It's because during the phases where nothing happens, they don't blow their account. And this is something I need to work on. I'm working on really hard to simply decrease your position size as your success rate decreases. There is something called the Kelly formula. I'm going to search it on the internet very quickly to show you because it's something we'll have to dig into it. The Kelly formula, very interesting thing. It's in French, of course. I'm going to have to put it in English so you understand. Boom, there you go. The Kelly formula is basically a mathematic expression that tells you to decrease your risk when your success rate decreases too. It's very interesting. It's very useful for investors. I'm gonna make videos about this because it's so interesting. I hope you're gonna like them. If you liked this video that was a little bit technical, but I think it's very interesting and very important that more and more people understand this. The more you understand this, the less you're likely to blow your accounts. And I think it's one of the most important things as a trader is really to survive. The longer you survive, the higher your chances of becoming a successful trader become. So that's it. This is just what I wanted to talk about. Hope you think it's interesting. If you think it's interesting, please leave a like, leave a comment. You can ask your questions in the comments or on the Discord server, and also follow me on Twitter. That's it. Have a nice week. Trade well. Manage your risk. Goodbye.